On the EA exam, capital asset is basically the default bucket. If it's property you own and it's not specifically excluded, it's a capital asset. Think personal use stuff, investments like stocks and bonds, and investment land. The trick is spotting the exclusions, because those exclusions usually push you into ordinary income rules and business forms. Here's the exam shortcut. Capital assets commonly show up as personal use property and investment property. Your personal car is a capital asset. Your stock portfolio is capital assets. Raw land held for investment is a capital asset. But if you're a dealer in that item, like a securities dealer holding stock for sale, those same items can flip into non-capital treatment. Collectibles are a favorite test point because they have their own long-term rate cap. If you sell a collectible you held over a year, the gain is taxed at your ordinary rate, but no higher than 28%. The absurd part, comic books, baseball cards, coins, wine, yep, all can be collectibles. But if you're a dealer, those collectibles are inventory, and the 28% concept doesn't apply. Now flip to non-capital assets. These are the big exclusions from the capital asset definition. Inventory is non-capital. Depreciable property used in a business is non-capital. Real property used in a trade or business, like a rental building, is non-capital. When you see used in business or held for sale to customers, your brain should move away from Schedule D and toward business reporting. Same object, different character, depending on why you hold it. A hobby collector selling a mechanical toy bank has a capital gain, usually on Schedule D. A pawn shop selling that same toy bank has ordinary income because it's inventory, reported on Schedule C, and it can trigger self-employment tax. On the EA exam, dealer is a flashing sign that says ordinary income. Business dispositions often run through Section 1231. If property is used in a trade or business and held more than 1 year, it's generally Section 1231 property. Net 1231 gain is treated like long-term capital gain. Net 1231 loss is treated like ordinary loss. That's why it's called best of both worlds, and why the exam loves it. Finally, match the asset to the form. Capital assets generally land on Schedule D. Inventory sales go on the business schedule, Schedule C or F, with cost of goods sold. Section 1231 sales are reported on Form 4797 and then may flow into other places depending on the result. Exam tip: if you see depreciation, think Form 4797 and possible recapture. Which of the following is not an acceptable inventory method for federal tax purposes? The options include an allocation method, LIFO, specific identification, and FIFO. Remember, the EA exam expects you to know the standard inventory methods by name. Think about it. The correct answer is the allocation method. FIFO, LIFO, and specific identification are recognized inventory methods. Allocation method sounds plausible because you do allocate costs inside inventory accounting, but it's not one of the accepted inventory methods you can choose as your overall method for tax. Bianca is a sole proprietor dog groomer. She has gross receipts of $63,000. Expenses: wages $6,000, supplies $7,200, utilities $1,500. She also has a Section 1231 gain of $2,200 from selling equipment, and she made a charitable contribution of $3,100. How much business income goes on Schedule C? Think about it. The correct answer is $48,300. Schedule C net profit is gross receipts minus ordinary and necessary Schedule C expenses. $63,000 minus $6,000 minus $7,200 minus $1,500. Don't subtract the 1231 gain here. That's generally reported on Form 4797. And the charitable contribution is tempting to deduct, but it's not a Schedule C deduction for an individual.